Thanks for joining us. Today we're going to talk about renting versus owning a home. And what we're going to do here is we're going to take a look at a case study. Before we get started, I just want to make sure that you realize that this is just a case study, and this particular scenario may not be specific to your situation. As a matter of fact, we do recommend that you do call your lender and get an accurate quote for rates and fees, because those will differ from household to household, being that rates and fees are based on a individual's FICO score, their loan to value, in other words, how much they're putting down, their debt to income ratio, how much debt they're carrying relative to their income, as well as the type of program and a number of other factors. So for the purposes of this, we're just going to have a generic scenario here. And again, this is no promise of rates or fees. Please contact your lender for your specific situation. All right, let's go ahead and take a look here. So in this case, on this box right here, we have a renter paying $1,100 per month, and then they also have rental insurance of $40 per month for a total payment of $1,140 per month in rent. In this scenario, we have someone purchasing a home for occupancy. We assume that the purchase price is $275,000, and it's a 4% 30-year fixed interest rate. In that case, they have a principal and interest payment of $1,082, and then there's also real estate tax and homeowners insurance equivalent to $290 per month. So we have a total payment now of $1,372. However, with mortgage interest, you can deduct that from your taxes. In this case, this individual is in a 25% marginal tax bracket, and we do recommend you contact your CPA to actually crunch your specific numbers. Again, this is just a case scenario. So in this scenario, it's a $257 a month tax benefit, as well as part of this payment, or actually this payment right here, includes principal and interest. There's going to be pay down of around $303 a month of principal, which means you're building equity, which equity means ownership in that property, which goes to your net worth. All right, so let's take a look at a 10-year scenario. So over a 10-year period down here, you can see this individual is going to pay out of their pocket $156,123. When you look at it that way, it is quite a staggering amount. Or if they purchase a property, they are going to build principal in this property of $45,225 over a 10-year period. Now, what they do give up by purchasing, though, is the down payment of 20% that they put into the property. So if you didn't buy a home and you kept that $50,000 plus in the bank, earning 5%, this is what it would grow to in, say, 20 years, $149,195 of liquid assets. Or if you look at it this way, if you purchase a property, you're going to build equity in the property, as well as the value of the property is going to rise. And looking at a 20-year period, you have a net worth of $391,030. So quite a staggering difference between those two as well. And then simply up here is just the difference between monthly payment. Now, given this is the real out-of-pocket, but net after tax as well as principal pay down, this is the actual true cost or net cost to the purchaser. If you have any questions, please feel free to give us a call. We appreciate you joining us, and have a great day.